opportunity to get us started. My name's Tim Valentine, and until very recently I was a professor of psychology at Goldsmiths College, and so I'm sure, like you, I've been a member of the USS scheme throughout my career. First of all, I'd like to thank you for coming and giving up your time to come and hear about climate change and your pension scheme. I'd like to thank the USS team for coming along and stepping up to our challenge to come and talk to members about climate change. I think it's probably the first time that a major pension scheme has come to engage with members on a responsible investment issue. So I think it's, we can't really overestimate the significance of this meeting. I've been involved in trying to persuade USS to adopt responsible investment, ethical investment as I realise now, it's getting on for 20 years. I first wrote to you in 1997. And there was a group there that emerged out of the union, discussions in the union, and it became known as Ethics for USS. And we were campaigning for USS to adopt an ethical investment scheme. And what they did very quickly, really, was to adopt a responsible investment scheme. So not the same thing as an ethical investment scheme, but it was a really significant step forward at the time, and we saw lots of changes, improvements in transparency about what the holdings of the pension fund were, and records of votes cast at meetings and so on. But I'll leave the USS team to tell you about that. Now, when I talk to my colleagues, when, from time to time there's a financial crisis, I find that most of my colleagues, especially our younger colleagues, will say, well, I'm lucky, I don't have any investments in the stock market. And yet, of course, for most of us, the bulk of our savings are invested in our pension, which are, of course, invested on our behalf by USS, and a lot of that investment is in equities. Now, most of us work for employers who will have a carbon reduction plan for their own operations, because the Higher Education Funding Council require them to have that plan, if for no other reason. Some of us have devoted our careers to researching climate change and understanding the impact of these issues. So why should we ignore the impact of the bulk of our own savings is having invested in companies that might not have a business plan that would be the way we'd hope to see it? I mean, some of those institutions have even divested or given pledges to divest their own endowments from fossil fuels. But so really the much bigger prize is to talk to the pension scheme. Now, so 2014 was a very significant year. For one thing, the Law Commission made clear that trustees are allowed to take non-financial factors into account, so for example, ethical issues, provided they had evidence that it was a concern that was shared by the membership, and that it wouldn't have a significant impact on the return of the pension fund. And so in December 2014, there's a regular USS institution meeting, so for the employers, and a group of USS members took a petition along, signed by more than 3,000 members, asking USS to carry out a survey of the membership so we can understand what the interests of members are, as a first step to then developing an investment strategy that's informed by those members' interests. And we've had a dialogue with USS since then, and that survey they have promised us will happen in 2016, so I look forward to hearing more about that. Now, climate change in particular is a particularly timely issue. Of course, we've had Paris in December 2015, 195 countries agreeing to a pathway to keep climate change within 2 degrees, or perhaps 1.5 degrees, which is a very challenging proposition. very important one, of course. But it has a big impact for the business plans of big companies that our pensions are invested in. So, for example, 80% of the fossil fuel reserves cannot be burned. They need to stay in the ground if we're to keep within the carbon budget to keep warming under 2 degrees. And of course, oil and gas companies are valued on the value of those reserves. So I think the particular issue on climate change can be made on a number of grounds. It can be made on financial issues, because we see the significant financial risk that exists for fossil fuel companies. It can be made on the quality of life for the members in our retirement, which is an issue identified by the Law Commission, and it can be made on ethical considerations. So I think the argument is getting ever more compelling. So that sets the scene of what we're here to discuss today. We're going to start with a presentation from USS, and I'd like to introduce Bill Galvin, the Chief Executive, who's going to start off the presentation.
Thank you very much. Tim, it's usually only when I stand up that people start leaving, so you're way ahead already. So thank you to UCU and Step Up USS for the invitation here. I'm Bill Galvin, Group Chief Exec, as Professor Valentine said, and joined by David Russell, who's the co-head of our Responsible Investment team, and Roger Gray, who's our Chief Investment Officer, and the Chief Executive Officer of USS Investment Management, our wholly owned investment manager. There are other members of the USS team hidden amongst you there in the audience, not surreptitiously, but they're here either because they're personally interested in this issue, or because I've asked them to come along, not as a human shield, but just so that we can get as much information sharing as possible going on. So our objective is to, as it says here, to share our approach on responsible investment, and with particular reference to climate change, to engage with you and get your thoughts and reflections, and areas where you agree and disagree with what we're doing, because that's all part of the dialogue, and it's all part of us all trying to understand how we deal with this issue. And it is a very important issue. One of the key things that I want to do in my piece here is to make sure that you understand the frame that we have for dealing with this as a pension scheme in this environment, with our fiduciary duty and our perspective on the economic and the investment landscape. I'm not going to spend too much time introducing USS. Many of you will probably know much of this, but I will make a couple of points relevant to this size. We are, in UK terms at least, a substantial pension scheme and a substantial investor. And this gives us opportunities and responsibilities, clearly. Opportunities to engage locally and globally with other asset owners to benchmark ourselves, to understand what is being done across the piece. Also to engage at policy level, at the UK and at an international level, to understand what policymakers are doing, what they are thinking, and how we might help them to understand our perspective and yours about the risks that are faced. We clearly have challenges like every other pension scheme, as referred to up there, our funding challenges. On our technical provisions measure of funding, we're somewhere between 80 and 85% funded, depending on the day that you look. And that has been after a substantial response to the funding challenges that we've had previously, and many of you will know. We've needed to close the final salary scheme, introduce a career average pensions accrual basis for everybody, and cap that at a level where people earning above 55,000 will be accruing defined contribution pensions in respect of that part of their salary. But nevertheless, we remain substantially invested in return-seeking assets. As Professor Valentine said, we depend on those assets, and the return on those assets pay the pension. And so that all of those things make us, I think, both in terms of our size and scale, and in terms of our investment portfolio, far from a standard UK pension scheme, which would tend to be smaller. In the DB space would probably tend to be closed if it was a funded pension scheme, and would tend to be invested in substantially more risk reducing or matching assets than we are. Now, USS has always been, we believe, a leader in the area of responsible investment. As Professor Valentine said, ethics for USS was started in the 1990s. Many people here involved in that. We have, we believe, more people involved in responsible investment activities than any other UK pension scheme. We have 7 people across our business involved in activities supporting our investment team in responsible investment type work, and David's going to talk to you in a few moments about what they do and how they engage. We've taken very seriously our duties and responsibilities in this space. We've taken legal advice on a number of occasions over the last number of years to make sure that we understand and can explain and understand the parameters and freedoms of movement that we have in terms of our decision making in this space. And that has given a relatively clear view and a clear mandate for us, in that USS is set up under trust in order to provide financial benefits to our beneficiaries. And the primary duty of the pension scheme and the trustee in running that pension scheme is to focus first and foremost on providing those financial benefits to its beneficiaries. And that's always been taken to mean that we cannot exclude investments solely on moral or other non-investment grounds. As Professor Valentine said, last year the Law Commission was asked to opine on the implications of the law for fiduciary decision making in the investment space, and came to a view that many of you will be familiar with. They came to a view that the law did not need to be changed. Now, we have, as a result of that, asked for our legal advice to be refreshed. And we've published that refreshed legal advice on our website, and you'll see it there. And the position that our legal advice has made very clear is that the duty of trustees as fiduciaries has not substantially changed. It has made some things quite clear. We need to distinguish very clearly between financial and non-financial factors. But having done that, financial considerations must be considered first. And subsequent to that consideration, non-financial factors can be taken into account. I would say at this point that I think the consideration of non-financial factors is probably, for the purposes of this discussion related to climate change, probably beside the point, because it is very, very clear that there are financial implications to investment decision making from the risk of climate change. So that from our responsible investment activities, while it's quite clear that we cannot first and foremost take a moral or an ethical view and on that basis divest from certain investments, what we do need to do is to understand where on environmental, social and governance issues there are financial implications, and make sure that we understand those and that we play those very clearly into our decision making activities. So it's very clear that we absolutely must, as fiduciaries, take these factors into account. But the question is how. And so we come to the mandate of our responsible investment team. They own this particular risk in USS climate change, and they play a role internally and externally in helping us to understand the appropriate response. Internally, in assessing the risk, in gathering perspectives and information and feeding this to the investment teams, in reviewing our decision-making framework so that the investment decision makers have very clear understanding of what their mandates and responsibilities are, and externally, the responsible investment team engage with policymakers and decision makers on public policy to understand what may happen in this space, what appropriate investment responses might be, and externally engaging with investee companies. Because the quite clear underpin to our responsible investment activities is the belief that, as it says up here, if we influence and promote good practice in investee companies and markets to which the fund is exposed, then those companies and those markets are most likely to be resilient in the face of the risks that are being exposed to. Yes, question.
Could I just ask a question?
Absolutely.
Sure. So my name is Ewan McGaffey. I'm from King's College London School of Law. I happen to teach trust law, and so...
Sorry, we've got a tight schedule for the presentation. Okay. Can you say, unless it's a point of information?
It is a very important point of information. So I'm just wondering who the legal advice was from that you got most recently, so on where you can invest and whether you can ethically invest. The leading case would be Harrods and Church Commissions. It does not say that you have to put financial interest first. It says that the trustee of a pension comes first. That's the most important thing. And so I just looked it up quickly there. I mean, and it's pretty plain. So paragraph 64.1 says that USS, that's the trust board, right? They can invest with full and unrestricted powers of investing, transposing investments as if it were absolutely entitled to the fund. So the stuff about what you might have heard about Cowan and Sky Law, that doesn't operate if you've got an explicit power of unrestricted investment in the trustee, which is the case with USS.
Thank you. So I guess we could spend a couple of hours here debating that particular point.
Hang on, the question was, who did you get your legal advice from? Can we just answer that?
So our legal advice is on the website. I think we've indicated who it's from, have we?
I'm not 100% certain.
We have. Okay, so
we'll have to share that now. It's DLA Piper.
It's from DLA Piper.
So they might be just, not very good.
So indeed, and I'm sure on this issue as on others, lawyers will differ. However, I will say.
I think
sorry, please, can we let USS give their presentation?
No, we understand.
There will be time for questions afterwards.
So we've got some clear legal advice, which has driven our policy, investment policy decision-making framework, and I think very definitely would be happy to discuss it afterwards. I think I'd refer everybody to our website where that legal advice is outlined. It quite clearly suggests that because of the nature of the activity in which USS is engaged, and distinguishes that from charitable trusts such as those involved with a particular mandate to their action other than providing financial benefits to members. And it also talks about how the nature of the underlying activity might allow different nuances in that decision making to be taken into account. But we'd be very happy to pick up that point afterwards and have a discussion about it, because it is a very important point. And it's something that we take very seriously, because it provides the framework within which we believe the trustee decision making needs to occur. And I think, as will become obvious as we go through the activities of our responsible investment team and the activities of our portfolio managers, this framework means that we can ask ourselves very specific questions. And in the context of climate change, I think that means that the question for us is not specifically what can USS do to reduce the risks of climate change globally, because that is not our mandate. Our mandate is to provide financial benefits to members. The question is, in the context of a material risk to the investment and to the environment, what is the right investment response in that context? And that is a more difficult question, I think, to answer, because it has several different facets to it. But that is the question that our teams need to be able to answer within the investment framework, as we and our legal advisors and the trustee board has interpreted it. So with that, I'll hand over to David to talk a little bit more about the detail.
Great. Thanks, Bill, and good evening, everybody. I'm going to give a brief introduction to the approach that USS takes to responsible investment and some of our views on climate change and where they've come from. Just as a start, I think it's important to say that our responsible investment activities apply across all our different asset classes. When people think about responsible investment, they just tend to think of public equities and listed companies. Well, actually, that's something less than 50% of our assets. We have real estate, we have private equity, we have infrastructure, we have other direct investments, we have bonds. So we have to think of all the activities that responsible investment, or the issues, the environmental, social governance, ESG issues, could have an effect on our different asset classes. Across those asset classes, we have a responsible investment strategy that's been signed off by the board and is refreshed every few years, that focuses on three areas: integration of ESG issues into our investment processes, engagement with the companies and other assets that we hold, and broader market-wide activities, engaging with policymakers. I'm going to go through a bit of information on each of those. I'll focus on public equities to start with in terms of integration. What we do for them is we provide them with information through their Bloomberg screens. Our fund managers get information, financial information and other data on the companies they're going to invest in through an online system provided by Bloomberg, which explains why he's a billionaire. We provide environmental, social and governance data to the managers through that process, through that screen, so they can see an assessment of how well the companies are performing in terms of environmental issues, social issues and governance issues, to flag up prior to investment where there could be concern. At that point they come and talk to us and we go through what the issues could be. Post-investment, we also analyse their portfolios and do a regular screen of their portfolios to see where the key risks are, and flag those to the managers and highlight what we should do about that, how they should incorporate that into their investment processes, their views on the companies, or whether we should use that as a basis for engagement with the companies. We also look at ESG issues in due diligence across our other assets, real estate, private equity, infrastructure when we invest in real assets. In terms of our engagement with companies, I'll focus on companies here, voting is a key part of that for USS. We vote all our proxies with companies in-house, and hopefully you can see the numbers of votes we did for 2015. We voted 538 different events and nearly 7,000 resolutions. Of those, we voted against management, which is basically abstain and vote against, voting against the management recommendation, just over 20% of times. What that hides is the fact that we will vote against a single resolution at between 75 and 80% of companies. So we're voting quite strongly on our views on how companies are managing various, mainly governance issues, and a lot of that's to do with executive remuneration. We also last year, it's not on the slide, voted roughly 100 environmental and social resolutions, and they tend to be in the US rather than the UK. There are a very small number of environmental resolutions in the UK. We also attend company meetings, And I'll talk on the next slide about engagement activities that we've done with companies. But we meet both as a responsible investment team, but also with our portfolio managers, so they can talk to board members or executive members around ESG issues, and they can have exposure to the issues there as well. A critical part of what we do is market-wide and policy activities. Very early on in the formation of the responsible investment team, which was in 2001 when one person became two and could call it a team, we decided that focusing on policy was an important aspect of what we should do. We can spend all our time engaging with individual companies, and we own hundreds of companies and thousands of other assets around the world. Whereas if we engage with policymakers on governance issues, on climate change issues, on other issues, if you change how the market is being managed, that's a far more effective way of improving standards than trying to focus on individual companies. So we've tried to do that over the years, working both individually and in collaboration with other funds. Speaking of which, we're strong supporters of something called the UN Principles for Responsible Investment, which sets a set of principles for responsible investment for global investors. It started 10 years ago with 36 signatories, of which USS was one. It's now 1,500 signatories globally, with pension funds and asset managers signed up to this, improving responsible investment standards.
David, you've 5 minutes left.
5 minutes left. We've been back 2 minutes. So we engage on a whole range of different issues, and I will not go through them all because I don't have time, but as you can see, we engage on climate change related issues, on human rights and supply chain related issues, and a range of others. And I can talk about these at length if anyone would like to go into the details. In terms of climate change, it was the first issue that I looked at when I joined USS in 2001. That year we published something called Climate Change, a Risk Management Challenge for Institutional Investors, which was the first report that framed climate change as an issue for pension funds. Based on that report, a group called the Institutional Investors Group on Climate Change, the IGCC, was formed, which is still going, which now has over 100 European members, and there's a version in the US and a version in Australasia, of investors that come together to address climate change related issues, including the policy engagement side. We've always had a belief in the broad focus of climate change and the fact that this is an issue that will affect us if it's not addressed, and hence we put a lot of resources into that. We do actively engage with companies on climate change related issues, what their policies are, how they're addressing policymakers, how they're engaging with policymakers, how they're mitigating climate change events, and how they're adapting to climate change, because that is something that is also an important part of dealing with the issue. As has been said, policy is important, we believe, and that's probably the area of climate change we put most of our resource into, working through the IIGCC and working individually, engaging with policymakers both in the UK and the EU and in other markets around the world. As I say, it's important to have a policy in place that provides for a smooth transition to a low carbon economy. We invest in companies across the economy, and they need to know where we're going in terms of energy policy, in terms of climate policy, so they can plan where to make their investments in the future. It also provides us with information for our portfolio managers as we're talking to policymakers, so we can keep abreast of and they can keep abreast of what's happening in terms of climate policy. Very quickly on stranded assets, you can't argue with the maths. You can't burn all the reserves and hit a 2-degree target or a 1.5-degree aspirational target. But there are other issues coming into play here. We still live in a world that requires energy, and the reality is that carbon-based fuels will provide that energy for the foreseeable future. We will move to a lower carbon economy, but we need energy in the meantime. Renewables and other alternatives are a critical part of that, and they're growing very rapidly, but they're going from a very small base. And you need lots and lots of 100% growth in renewables to start impacting the amount of carbon-based energy that's being used. And as I say here, emerging markets are still energy poor, and they will be putting in place carbon-based generation because they need it. You also have to differentiate between oil and gas and coal. So with coal reserves, you can basically a coal company is valued on the amount of reserves it has. You can see the hole in the ground, you can see where the reserves are, you can work out how much it's digging out each year, therefore we can value the company. And just as an aside, we don't hold any pure play coal in our active portfolios, and we haven't for a number of years because the managers sold out for a number of reasons, including air quality policy in the US as an example. We do hold it in the passive fund. We have an index fund, and last time I looked, we had £1,500 worth of exposure to a company that used to be called Boomi, and now is now called Asia Resources Limited. There's a very small exposure. We do hold BHP, Rio, and some of the big diversified miners where thermal coal is a small part of their business.
Okay,
Oil and gas.
if you can bring it to a close, a minute or so.
Oil and gas companies are valued on their P1 reserves, their proven reserves, and they will last about 10 or 12 years. The chances of any other alternative coming in 10 or 12 years to replace oil and gas is quite low. So our financial exposure to stranded assets in the oil and gas sector is relatively low. Sorry, Roger, you've got...
Yeah,
30
do
seconds.
you want to stay there?
I'll stay here.
Just you can flip the slides quite quickly. So this is a quick review in a few slides and probably overrun in 3 minutes if I may. Firstly, let me say this has not been a very profitable area of investment, clean tech or renewables, if you take the last 20 years or thereabouts. We started doing this in about 2000. My late colleague, Joe Deere, he was the CIO at CalPERS in a Wall Street Journal article in 2013, said clean energy is a noble way to lose money. And our experience hasn't been that desperate, but it really hasn't been very good until, I hope, recently we've maybe found a different way to access this. So we are very dependent on funds for the investments that we made, and we've shifted to a more direct posturing of certainly our private investment program is now things like the Signal. Big deal in this space was buying about £300 million portfolio of loans to wind farms. They're fairly long-lived loans in a sector that we've tried to come into on a couple of occasions, at least. Previous to that, we participated in various bidding for offshore transmission assets related to offshore wind farms. Unfortunately, the price of carbon hasn't done what might have been expected to have been done for various reasons. Financial crisis certainly didn't help. Reneging by the Spanish government didn't help, but carbon isn't £45 per tonne. It's whatever it is, recently £7 per tonne. We've done things not only directly in clean tech and renewables. We have got some timberland assets in Australia and the United States. It's an area that we're very happy to invest in. It does depend on policy to make it very remunerative. The next thing is a carbon footprint. We've signed up to the Montreal Pledge. You can see on our website the carbon footprint of our public equities portfolio, which is considerably lower than the benchmark against which we are compared. And we were dependent, we started doing carbon footprinting in 2009. We relied on Trucost to help us with that, and we now have the capability to do this internally. Indeed, we're at present working on a very challenging project, which is to extend this carbon footprinting across the whole portfolio into our private markets and our debt investments. We don't think there's any other fund that has actually successfully completed that. I don't know that many have undertaken to do it, but we're going boldly forward on that. And I should explain, and this is the segue to the next slide, the reason why we are doing this is to guide the investments that we make. So at the end of this, we want to know where have we got significant carbon exposure? How is that carbon risk priced in the market? And we may find, if policymakers are going to put their heads in the sand, that coal is actually a great investment. And just to, I know that's a shocking thing to say, so I'm going to move on quickly. That happened to be our emerging market portfolio. But here is, what's the worst thing for you that we've all known about for the last 50 years, and it's tobacco. And then we have this sort of rather shocking thing that this is over 20 years, tobacco is right up there. Go back 40 years, and the tobacco sector in the UK market has trebled the returns achieved on the FTSE, and that's been a pretty fantastic period overall for equity returns. So it's a bit embarrassing that our society allows that to happen, but the part we play in this, the primary role we play in this is as investors. So we certainly want to invest smartly and in an informed way, understand carbon risk. In this room, I would say I and my colleagues would be as much learners. There's a lot of knowledge about carbon risk and hopefully the future policy that's assembled here. And that's something that we assess and take very seriously. I think that's probably all I may talk about now.
Should I skip on to the last one?
Yeah.
Okay, thank you very much. So we're going to have a panel discussion, so if you want to stay where you are. If I can introduce Juliana Reinecker from Warwick, who's going to chair the panel. We'll probably just take a few moments while we get the panel members up here.
I'm here, I want to